I see blockchain and Bitcoin as currency, not money, which is what I see as gold. So what I like about blockchain itself is the decentralization of the system. And what FTX is about, and actually to some extent is foreshadow of the problem with the current banking system, because it's the leverage within the system. Like if you look at FTX, it's all the money that was borrowed, or all the assets, all the coins that were borrowed against the coins that were lent to these exchanges.
Yeah.
So first of all, what it is using centralized system. That's the past banking system. The centralized tools within a decentralized system is not going to work.
Welcome back. My next guest is Jaime Carrasco. He is a 25-year veteran investment advisor with Canaccord Genuity. Jaime, welcome back.
Thank you for having me back.
Yeah, it's been a while, and you and I have both been on the same page, more or less, in terms of gold as a pretty substantial hedge against financial calamity. And recently, the collapse of FTX under Sam Bankman-Fried has kind of built the argument in favor of gold that crypto is not likely going to be a replacement for gold in the whole global financial system anytime soon, at least not until these issues that caused the collapse of FTX are resolved. So in your opinion, do you think that this event, the collapse of FTX, is it something that has wiped out any chance of Bitcoin becoming an alternative currency in, say, the sovereign case?
No, actually, I think that what it proves, I've never looked at Bitcoin as an alternative currency, as an alternative to gold or monetary. I see blockchain and Bitcoin as currency, not money, which is what I see as gold. So what I like about blockchain itself is the decentralization of the system. And what FTX is about, and actually to some extent is foreshadow of the problem with the current banking system, because it's the leverage within the system. Like if you look at FTX, it's all the money that was borrowed, or all the assets, all the coins that were borrowed against the coins that were lent to these exchanges.
Yeah.
So first of all, what it is using centralized system. That's the past banking system. The centralized tools within a decentralized system is not going to work. Now, the way I look at that is I look at the current banking system and look at the leverage of derivatives within the system. We have $2.5 trillion within the banking system of derivatives that are just a subject to the similar circumstances as FTX. So I also see it as a foreshadow of the problems with the banking system now that interest rates are finally rising, the problems that we saw in the UK with swaps as the volatility within interest rates and currencies are starting to deliver. Blockchain, though, is different because I see that as the decentralized future in terms of, I've always understood, or the way that I see blockchain as doing to the same thing that email did to the post office, blockchain can do to the banking system because it takes away the control from them. Now, that is the problem, is the leverage within it, right? So those that got caught within that demise were people that were lending or depositing their coins within these exchanges in the same way that people are depositing money within the banking system. It's funny, on October 14th, the Fed had a news release that came out whereby they were actually saying that it was a news release where they were looking for public comment. Now, when the Federal Reserve Board asked for public comment is from the banking system in the event that the large banks default. Now, that was a news release, and I posted it on LinkedIn. But to me, the problem is the leverage in the system. So I see gold, I've always understood gold and silver as needed for the cleansing of the past, but blockchain is the currency of the future by which we will transact. Now, I think Putin made a pretty interesting remark about a month and a half ago where he said that Russians cannot trade Bitcoin internally or use it to transact internally, but Russian companies can use Bitcoin to settle their foreign trade. to me, he understands exactly what I'm talking about. What he's saying is, if you want to settle your foreign trade using Bitcoin, you don't have to go through the banking system. And that's the importance of blockchain, that it decentralizes, it puts the control of all those transactions within the individual. And to me, that's very liberating, because my problem, having worked within the banking system forever, is the banking system and the leverage that it controls. And a lot of people just don't understand that. But now that we're starting to see interest rates rise and foreign exchanges become so volatile, it's creating problems within the derivatives of the system, which is far greater leverage than the leverage that FTX was carrying. So I see it as a very good cleansing, because it's getting rid of the I'm trying to use a polite word, but the decentralized tools that I don't believe in them. Sorry, the centralized tools of the banking system.
So an exchange is a centralized apparatus within the decentralized ecosystem of cryptocurrencies. And they're centralized because they're owned by private interests, and the private interests are able to obscure the degree of leverage that they've created for themselves. And I find it especially onerous in the case of FTX and Alameda Research, where that interpersonal sort of cross-ownership exists, where, they're lending money to Alameda from the balance sheet of FTX, and then Alameda is using that money to buy FTT, the token of FTX. And so it's really a very profound example of wash trading and insider trading.
Well, look at the SLV and the GLD, right? Look at what's happening internally within them, and the fact that, are they backed by all that physical that they say they're supposed to have? How much extra leverage is there within those products? The same thing with the ETFs in the system. That's why, to me, I understand counterparty risk very well, because to some extent, I was at the apex at the start of all that, because that's what we were doing with Gordon Capital back in the I got to go back a lot, in the early 90s, late 80s. When I started in the business, we were creating repos, right? So repo trades are the basis of all derivatives.
Right.
And the man at Gordon understood the leverage we were taking. And that's why at one point they shut the repo desk, even though today it's, with after they won Glass-Steagall, that leverage has grown exponential. And other people, I think, are completely not ambivalent. I just think they don't understand what is happening. But once you start looking at FTX, you start looking at all these things, you begin to understand the leverage in the system.
Yeah, right. So then what is it about gold that prevents such leverage from causing a run on the bank of the type that we saw with FTX?
Well, he who owns the gold physical makes the rules. That has been the number one rule of power for 4,000 years, right? And today it's China that owns that gold. So look at what's happening around us within the monetary system, where you have a definite cleavage occurring within the BRICS nations and the developing world that's saying, well, maybe we don't want to deal within the US dollar, the past currency reserve anymore, considering all that leverage that is in place, and we might want to go at it on our own, right? So go back to March 1 of this year was, to me, the end of the old currency reserve, because that's when they kicked the Russians out of selling energy within the SWIFT. By default, they forced them to sell it in rubles. But what the Russians said was, well, if you don't want to sell it in rubles, we're going to peg the ruble to gold, right? And that peg has grown in value greatly now that the ruble has appreciated. And the ruble has appreciated more than the US dollar over this year, and it's holding that value because energy is needed and people are going to buy energy. Now, this is important because people have to understand that when we come out of the gold standard in 73, in 75, Henry Kissinger sets the new petrodollar. And what was the petrodollar about? It was about the biggest energy producer, Saudi Arabia at the time, and the biggest energy buyer, the US, setting the currency by which they were going to function or trade. And then it forces a country like Chile to start to buy energy in US dollars. So they're forced to acquire dollars and acquire US debt because those were going to be long-term trades. Well, the mechanics have changed today because why is Saudi Arabia, the United Arab Emirates, jumping on board with the Russians? Because today the biggest energy producer is Russia. And the biggest energy buyers are China and India, right? And between the two of them, they can set the market and they can set the currency by which we're going to trade energy, forcing everybody to apply that currency. Now, so let's follow that mechanic for a second, because if you look at what's happening right now, you have India, you have Iran, you have all of these countries trying to do trade between themselves in their currencies, but they need to peg that. So what the component that's missing is the component that's supposed to come out of China. And what China said was that what they wanted was a blockchain-based blockchain gold-backed commodity basket. Now, to me, that's a beautiful thing to hear, because you have to understand that the gold standard was good for the British, first of all, and then good for the Americans because they control the purchasing power of the currency reserve. What the Chinese are proposing benefits everybody, because go back to Chile. Chile is the world's biggest producer of copper, but they don't have any gold. So by default, they took second fiddle to the British and the Americans in selling that copper because the currency never appreciated. But if now you have copper pegged to the currency reserve, well, the Chilean peso would appreciate. Same thing with Saudi Arabia if oil's in that commodity basket. So the fact that they're proposing a commodity basket for the currency reserve, I think we're starting to see the composition of the new currency reserve, and I think it's very positive because it's going to be more beneficial to the whole world, and that's why I think a lot of countries are coming on board with the BRICS.
Okay, so then on the 10th of this month, gold broke out of its range-bound sort of 1650 to 1700 trading range, and it's increased by, like 10%, 12% in the last 5 sessions. So is that related to what's happening with BRICS or to the FTX crash?
No, I think that's related to a couple of different things. First of all, it's important to point out that gold and silver are the only two commodities that never inflated since 2020. Right? Why is that? Isn't that kind of silly that everything has inflated, everything's gone up in price except gold and silver? Well, look at what happened last quarter. Last quarter, global central banks purchased 400 tons of physical gold, okay? But yet, I kept flagging this on my Twitter feed. On October 13th was the last one that I flagged, but throughout the whole quarter, on October 13th, in a period of 15 minutes at 3 a.m, somebody sold 47 tons of paper contracts, just in 15 minutes. Now, through that day, they must have sold about 100 tons of contracts. If you add up all of the paper contracts that were sold within the whole quarter, we're looking at about 4,000 to 4,500 tons, way beyond global production. Well, there's counterparty risk at its best, back to FTX. Who's going to cover all of these paper contracts that have been sold? Well, that is the con game to me. That is where investors should be looking at what is actually happening. How come gold and silver have not inflated since 2020? And are they ever going to catch up? Well, I think they will, because the price hasn't been allowed to emancipate for quite a while. Silver, to me, is a better opportunity because silver hasn't emancipated for 40 years. It's still here at $20. Now, that is an economic anomaly that I love anomalies, but you need the patience to let them play out. Because inflation is rampant, central banks are printing money, and hey, they're chasing physical like crazy. So what I think what's going to happen at some point, the light's going to come on, and it's starting to come on because we're starting to see it on the physical demand. I'm getting letters from dealers that I've been buying silver forever, that they want to buy my silver from me above spot now because the demand is so strong. So that's starting to happen. I think what we're going to end up with is an obtainium, where people are going to finally, the light's going to come on and they're going to be looking for physical. They won't be able to get it. Look at what's happening with the Ontario teacher pension plan here, where they've lost all this money in FTX. You have the pension plans in the UK and some in Holland that have lost money in the swaps that they were doing. Well, those are derivatives, right? They don't have any gold. If you look at the current, even though central banks keep buying it at very cheap prices, look at the asset allocation of gold right now within the system. It's half of 1%. That's crazy. Last time we were at the level of inflation, we were sitting at 7 to 8%. So I'm just waiting for that flow of funds to come in and come my way. But in the meantime, you have to have the patience to allow to sit there and buy right, sit tight, and understand what you're buying.
Yeah.
Now that's where asset allocation comes in.
Yeah. So we've seen sort of a real bear market in junior mining companies involved with silver and gold. And does the current environment or any of these sort of macroeconomic movements portend a potential brighter future for the junior gold sector?
I truly believe it is, but you need the patience. It's funny. In 1998, I was managing Microsoft at the time. I was managing their Canadian pension, and I had a lot of clients with Microsoft stock, and I was looking to get out of Microsoft, the growth story, and we were moving over to Brandis, which was value, Warren Buffett. Well, nobody wanted to buy value because growth was going. It was the same thing. It was the time to be getting in and start building your positions, but people weren't coming in. So to me, it's a beautiful thing that I own the one thing that nobody owns, right? And we're going to go back to a similar situation as in the 30s, where the price of gold went through the roof. Nobody could own it, but you can own the gold on the ground within the companies. That's why the producers, to me, are producers, developers. Last year I was adding American developers because I think in the U.S. you're going to end up with the same level of euphoria as you ended up with fracking, especially some of these silver mines that were shut down in the 80s, gold mines that were shut down in the 80s. So you have reserves on the ground already found, trading at ridiculous prices. I thought I was buying them cheap throughout last year, and towards the beginning of this year, I was paying between $40 an ounce on the ground, and they've gotten even cheaper, right? Again, I think there's massive opportunities, but hey, people don't like to buy cheap things when it comes to investing, only when it's at Walmart.
Yeah.
Right?
Right. Okay. So then in the junior gold universe, do you have a criteria that you follow when evaluating investability?
Yeah, well, first of all, we have to separate between exploration, where I've made quite a bit of money over the last 2 and 3 years, where some of the explorers did extremely well. Then within developers, which is a bit of a harder mechanic because inflation's kicking in, it's going to cost more to build the mine, and price will solve that. And then within the producers that have low cost of productions with resources, right? So first on the exploration side, I would be looking at the teams that are looking where they're looking. Have there been other exploration plays that have been found in those areas? Then assess the geopolitical risk of those areas, the royalty structures, how the land leases are, the legalities of those countries. And then, the level of infrastructure to bring in those plays, that as well is important. It's funny, I hadn't looked at Africa much, but with Fortuna having bought that Africa gold mine, and it was a hell of a purchase, I started looking at Africa now and started to study that area. But the Americas is the place where I really invest because I'm from Chile and I understand it. On the development side, what's happening in the U.S., I think it's amazing because the U.S. is a bit of a time capsule, because sometimes around the 80s, all of the development and things that were discovered already were shut down, and then everything was shifted over to Asia. Yeah. Now, massive problem because the Chinese don't want to sell it to us. And so that's where on the development side you have a lot of good opportunities. And then when it comes to the producers and the royalty companies, which are a little bit of a different animal, the safer, but within the producers, what I'm looking at is, first of all, the reserves on the ground, what I'm getting for those, the cost of production, the management team, and the geopolitical risk of the plays. But within that, what I always recommend is, for example, in my special opportunities portfolio, where I have only producers, I have no development. Those are outside, and the exploration are also on the more aggressive side, where I participate with accredited investors that understand the risk and can take it.
Interesting. All right, Jaime, we're going to leave it there for now. I really appreciate your input today. Thanks so much for joining me. We'll have you back soon.
Thanks, James. Appreciate it.
Bye for now.